I started investing in 1995. I was 26 years old. I had read about compound interest. I had read about dividend reinvesting. I understood the math, but understanding it on paper and watching it work for 30 years, those are not the same thing. And after 3 decades, I can tell you, there's a difference between reading about compounding and watching it happen in your own account. Here's an early McDonald's statement from 1995. You'll see the dividend was 6.75 cents each quarter, or 27 cents a year. Stock price was just under $38 a share. Fast forward to today, and the stock hovers in the $300 range with a yearly dividend of $7.44. Now, one more thing. There was a stock split in 1999. So for those early shares, that $7.44 dividend is really $14.88 per share. I've seen what dividend reinvesting can do. Not because I studied it, because I lived it. Small amounts, $50 here, $100 there, reinvested, quarter after quarter, year after year. Now shortly, I'm going to show you the one number most people never check. The one that tells you whether a dividend is actually safe. So stick around for that. But first, let's talk about what a dividend even is, because most beginners get this story wrong before they even start. A company makes money. They have a choice: reinvest that profit into the business or pay some of it out to the shareholders. That payout is a dividend. It shows up as cash in your account typically every quarter. Now, most people assume a dividend is a bonus, free money, but it's not. Before the dividend is paid, that cash is reflected in the stock price. After the payout, the stock adjusts down by roughly the same amount. The value didn't appear out of nowhere. It moved from the share price into your account. Now, that's not a bad thing. It just means you didn't get something for nothing. And that's actually the point, because what you do with that cash next is where the real story begins. When a dividend lands in your account, you have 3 choices. 1, spend it. Treat it like income. And that's fine if you need the cash flow. But understand, you've removed that money from the market. It's not compounding, it's gone. 2, reinvest it. Buy more shares automatically through a drip. The cash never touches your hand. It buys fractional shares. Next quarter, those new shares are going to buy their own dividends, which buys more shares, and that's compounding in motion. 3, redirect it. Take that cash, put it somewhere else, a different stock, a different fund, and this works if you want the income, but you're not sold on adding to the position that it came from. Now, here's what 30 years taught me that the books didn't. And I get it, I'm speaking from 30 years of experience, and you're probably sitting there saying, all right, dude, you're telling me something, and I'm in my mid-20s. You're talking, hey, 30 years out. I can't comprehend that. I get it. I was there in your position. Trust the system. I'm showing you proof. It does work. Just stick with it. When I was starting in 95, I was sending in small amounts, $50, $100. Those dividends were, the first few years, they were tiny. I'm talking pocketbook change. And I'll be honest, it felt like I wasn't building anything. The math said I was, the statement said I was, but the dollar amounts were so small, it was hard for me to see it. By year 10, those reinvested shares were starting to generate their own dividends. By year 20, the quarterly payouts were larger than what my original contributions were. By year 30, I'm looking at numbers that the 26-year-old me sending in $50 at a time just would not believe. I had, in essence, created a stream of income for myself, almost like a little pension-like. Now, I'm still reinvesting that. I don't need that money yet, but one day I will. Let me show you what that actually looks like in numbers here when evaluating. Take a stock trading at $50 a share. It pays a 2% dividend. That's $1 per share annually. Not exciting. A lot of people will scroll right past the 2% yield looking for something bigger. But here's what they miss. If that company grows its dividend just 7% a year, and that's not unrealistic for a healthy company, That dollar is not a dollar for long. Year 1, $1. Year 5, $1.31. Year 10, $1.84. Year 20, $3.62 per share. Year 30, over $7 a share per year from a stock you bought once. I showed you the example of McDonald's. There's your proof. Now remember, that's the dividend on just one share. If you're reinvesting, the number of shares you own is growing the whole time. So you're getting a rising payout on a rising number of shares. That's two engines pulling in the same direction. Now, let me put this next to something most people understand. A savings account. Put $10,000 in a savings account at 4% interest and leave it for 30 years. You end up with about $32,000. Now, 4% is generous by today's standards. But here's what a lot of people don't think about. Inflation today is running roughly around 3%, 3.5% over the long term. So even at a generous 4%, you're barely maintaining your purchasing power. You're not getting ahead, you're treading water. Now take that same $10,000 in a dividend growth stock, yielding 2% with the dividend growing at 7% a year. The stock price itself, if it appreciates roughly in line with its earnings growth, compounds too. So you're not just earning interest on a fixed rate, you're earning a growing payout on a growing asset. Your dividend is certainly separating from inflation. The savings account never does. That's not a stock picker's fantasy, that's just pure math. And I've watched it play out in real accounts for 3 decades. Now, there's a tax piece here that catches some people off guard, and I'm not talking about any kind of theory, this is real. I've had clients who didn't know that dividends were taxable in regular brokerage accounts. They've been reinvesting for years and never reported a dollar. Here's what happens. Your brokerage doesn't normally mail you a 1099 div, D-I-V, okay? A lot of them, they'll send you an email telling you that it's available to download. A lot of people, they ignore it. They see the email, they don't recognize what it is, and then they move on. Sometimes in counseling sessions, I'll sit down with them and I'll say, well, did you report your dividend income? And they look at me like I was just translating French. They say, but I never took the money out. C'est dommage is what I tell them. That's all I know from 2 years of French. Reinvestment doesn't mean untaxed. The IRS doesn't care whether you spent it, reinvested, or it's just sitting there in cash. It hit your account. It's income. Now, if this is inside of an IRA or a Roth, okay, now we got different rules. But a standard brokerage account, you're getting a 1099 every year. You need to account for it. All right, so earlier I told you I'd show you the number that tells you whether your dividend is safe, and so here it is. It's called the payout ratio. A company earns a certain amount per share, let's say $2 per share in profit. If they pay you 80 cents in dividend, the payout ratio is 40%. They keep 60% to grow the business, and they gave you 40%. That's healthy. That should be sustainable. The company has room to keep paying and generally room to raise a dividend over time. Now, let's flip it. Same $2 in earning, but they're paying you $1.80 in dividend. That's a 90% payout ratio. They're sending almost everything out the door. If earnings dip even a little, that dividend is at risk. But here's what I observed over 30 years on both sides of the desk, investing my own money and reviewing portfolios and lending. Once people get comfortable with dividend investing, they start gravitating towards the biggest yields. It's almost like a natural progression. You see a stock paying 2%, then you find one paying 5%, then 8%, and without realizing it, you're not investing in companies anymore, you're shopping for percentages. I've reviewed portfolios where someone had drifted into nothing but high yield stocks. Several of those companies haven't grown earnings in years. The yield looked good on screen because the stock price kept dropping. That's not income, that's a trap wearing a percentage sign. Don't just ask, what's the yield? Ask, can the company support the dividend? The payout ratio tells you. It takes 30 seconds to look it up. Most people never check it, and I've seen what happens when they don't, from both sides. So here's what I want to leave you. There's a difference between looking rich and building wealth. Rich can be spent. It shows up, it disappears, and next month you need more. Wealth keeps working. Wealth compounds whether you're watching it or not. A high dividend yield can make you look smart for a quarter. A sustainable dividend that grows year after year, that's what builds wealth. The savings account barely keeps up with inflation. The dividend growth stock pulls away from it. That gap, that separation, is the difference between maintaining your purchasing power and actually building it. I didn't read that in books. I watched it happen, $50 at a time for 30 years. The dividend itself isn't the goal. It's a tool. Reinvest it, and it becomes one of the most powerful tools that you have. If you want to build your finances the right way from the start, subscribe. I use real experience, not hype, to help you make better money decisions. Now, I'll see you in the next video.